see your lovely face. Hi, we're going to go ahead and get started. Thank you all for being here for TMC Connect. We appreciate it. Got a great webinar for you today. Britt Haven and John Sayer with FBX is going to give us some hindsight 2020 recap of the 2020 and insights for 2021. Want to just let you know that this is being recorded, so you will receive a follow-up email tomorrow with a link to the recording. Everyone's been muted, but please feel free to ask your questions in the Q&A or the chat function, and I'll be able to address those for you on my side. Do appreciate you coming in, and I'm Tony Bramley, Business Development Coordinator with TMC, and I'm going to let Britt and John introduce themselves. So thank you all very much. And with that, I'm going to turn it over to Britt.
Awesome. Thanks so much, Tony. Good afternoon, everyone. Thanks for everyone taking some time out of their day to join us. I see a lot of familiar names on the attendee list, but for those of you that I haven't met or talked to before, it's great to meet you over a webinar. With me on the webinar today is John Sayer. He is our VP of Client Success. So he runs our client success team. He works closely with the sales team, bringing on new clients, working with existing clients on an ongoing basis. He's been in the industry for many years. Prior to joining Informa FBX, he ran capital markets for a few large, well-known lenders. So he's got a lot of mortgage experience. I'm Britt Haven. Again, for those of you who haven't met, I am the Sales Director of Lending Solutions, so part of the mortgage sales team at Informa. I've been with the company for a little over a year and in the industry for a little over 10 years, which is kind of crazy. Mainly on the vendor side, unless you want to count my college internship with New Century Mortgage in 2006. Also, we'll be leading the bulk of the webinar today. However, we may have a guest appearance from our counterparts. John, if you want to, there we go. Paisley and Gunner. They tend to like to chime in from time to time now that we're working remotely. So if you hear them in the background, that's them just chiming in. Now, I want to jump to the next slide. Great. So as Tony said, we're going to hindsight 2020. We're going to take a look at some of the key factors around the mortgage market for 2020 and talk a little bit about how to prepare for a changing market of 2021. Again, we want to look at some high-level metrics over the last year. Obviously there's a lot else going on besides just crazy volume. So I want to share some of those insights with you. And then, as we look into 2021, what can we glean from 2020 to pull in and, use for best practices this year. So I'm going to start with a little bit of 2020 overview data, and then John's going to talk about some 2021 strategies. Kind of before I jump into the data, want to just quickly again give you an idea of where we're getting the data, what gives us the right to make these statements and these observations. So our benchmark is we get on a weekly basis app lock and funding data for retail, wholesale, and correspondent. Today, everything we're going to be looking at is retail. On the retail side, we capture over 55% of retail mortgage originations, which makes the data statistically significant. And it's a makeup of national banks, regional banks, IMBs, credit unions, kind of a mix across the board. And our clients that contribute, they use the benchmarking data to understand market share, operational efficiencies, business mix, pricing competitiveness. So again, we're going to share a little bit of that with you all today. So to jump in, at an overall US 2020 in review, we captured in funding for retail only a little over $1.1 trillion in retail funding in 2020. Fun fact, correspondent was at about $655 billion and wholesale was $135 billion. So overall, across all three channels, roughly $1.2 trillion, almost $2 trillion in funded loans last year. So again, the rest of this information is all retail retail specific, but did want to give you those correspondent and wholesale numbers. So again, retail, $1.1 trillion, that's 68% growth year over year. How it breaks down, the retail, about 65 decentralized, so branch volume. Centralized is about 35%. Centralized was up by 138%, as you can see. So again, kind of a shift in migration and share, growth in the centralized channels as opposed to solely branch. On the lender type, 45% financial institutions and about 55% were mortgage banks, IMBs. Financial institutions are, banks and credit unions combined. IMBs were up by about 112%. And when we jump to some of the operational numbers, you'll see that the IMBs were able to, their velocity on closing loans was on average higher than banks and credit unions, which is why you see that number up significantly. The breakdown, about 36% was purchase, 51% was rate term refi, 14% was cash out. Again, obviously, no surprise that refis were up by about 180%. So, John, if we can jump to the next slide and we'll talk about the East Coast specifically. So East Coast is, let's see, Louisiana over, up. So Texas and over is West Coast, East Coast is all the states listed there. So pretty close 50-50 on the overall volume. It's a little bit more skewed towards call centers than branches for the East Coast. From a volume perspective, Florida, New York, Illinois, Virginia, New Jersey had the highest volume. Largest growth, which we'll talk about later, was in Virginia. But again, pretty close to the averages that you see for the national view. As we're going through all of this, again, if you have specific questions, definitely throw them into the chat. If you do want any additional specific data or us to drill down on anything, definitely email me afterwards, and I'll be happy to provide information for you. I want to jump to the next slide. Perfect. So we've shown on the next few slides the operational turn times for refis only, broken it out by conforming, government, and non-conforming. And we're just focusing on refis as we're looking at the operational turn times, because really that's, refi business is where there's the most control. Purchases are going to close when they close, but refis, there's a little bit more, again, based on capacity. So you'll see that for the entire U.S., this is for conforming, refis, retail only, leveling off at about 75-day turn time. Obviously, it dipped down in March, with the liquidity crisis there, but then tapered off at about 75 days. Looking at the second half of the year, kind of excluding the first half and that dip in March, the average turn time was about 71 days for the second half. The East Coast states or Eastern U.S. states were at about 73 days. For the second half of the year, Tennessee came in fastest at 64 days. Alabama was right behind it at 65. Your slowest turn times on conformings were New York at 99 days, and Vermont was at 87. The overall in the country, the fastest non-conforming for the second half of the year, Utah was at 61 days, and New York was at 99. And then just looking at this year, so the last 4 weeks, the month of January, average turn times were for conforming for the U.S. were up by a couple of days at 73 days, East Coast 76. Minnesota is actually the fastest, and New York still lagging. New York is at 105 days. Take a look at government. So government turn times, about 20 days faster than conventional. So they're hovering, around towards the end of the year, around 55 days. The last 6 months, they were at about 54 days, and the East Coast was right there at 54 days. Tennessee was shortest turn times with 46 days. New York, slowest turn times with 80 days. Overall, Tennessee, Arkansas, and Montana were all tied for first for the second half of the year at 46 days, and New York was last at 80. The last 4 weeks up by a day, average 55 days. Wisconsin was is as fast as 36, and New York is at 84. So a little bit of slowdown over the last month, but consistent with what we saw over the last 6 months of the year. Non-conforming, no surprise, a little bit longer turn times for the country. It's up around 90 days for the majority of the year. Actually, 95 days was the average for the last 6 months. East Coast was about 73 days. Mississippi had the fastest time by about 8 days with 72-day turn times. New York was up to 131. But surprisingly enough, on the non-conforming, Nebraska had the slowest turn times for the last 6 months at 198 days. So obviously, non-conforming, no surprise, is a little bit longer. Part of that is obviously the products themselves, and then also the majority of non-conforming is done by banks, which historically just have a slower turn times. So then pull a little bit of the business mix. This is overall for the country, looking at year to date for 2020, looking at all fundings and year over year growth in specific products. So, obviously your non-conforming or your conforming 15-year is up by 162%. No surprise there with rates so low. People are opting into a shorter term loans, but obviously conforming 30-year was by far the largest product. You'll notice that VA IRRRLs, agency 30-year jumbo, VA jumbo, conforming 20 were all up by over 100%. Some of them up by almost 200 or over 200%. VA IRRRLs, 30-year VA IRRRLs were up by 287%. Obviously, agency high balance non-conforming were down. No surprise there, as that with the financial crisis in March, that market somewhat contracted. But again, this is just kind of a snapshot, high level for 2020, where loans were originated from a product level. When we look at the geography, looking at just the eastern U.S. states, as I mentioned earlier, Florida had the largest volume, but was actually kind of on the bottom 5 for overall growth. Virginia had the largest growth at 124%. Maryland right behind it at 101. Louisiana, New Hampshire, Mississippi, all in the high 90s. Lowest growth was New York at 36%, and then Florida, Ohio, and Michigan were all in the high 50s, low 60s. So again, just kind of an idea of where volume was originated, what states made up the largest volume, but then also the largest growth year over year. So that's a little bit of 2020 history. I'm going to hand it over to John to let him talk a little bit about focusing on 2021 and how we can prepare for this coming year.
Awesome. Thanks, Britt, so much. I'm a bit more camera shy looking at the screen here and make sure I get all this right. Just wanted to reemphasize that the data that you saw was the data that we sourced directly from lenders. We do that every week, and it represents over half of all the loans that were originated last year. So we really do feel, when you look at these different numbers in terms of product and market growth figures, that you're getting a really good statistically representative picture of what transpired last year. And I will ask if there are any questions that I can't see before I hit 2021.
I don't see any, John.
Any questions? Okay. Cool. Well, stop me, interrupt if you could, Britt, if there is anything that surfaces. So let's think a bit. We saw 2020, you know, the big headlines there is obviously a refinance market. We did see the purchase market grow though as well, right? 14%, the purchase market was up. The overall market up 68%. We did see that migration from of share. Everybody grew their business, but share migrated from financial institutions to mortgage banks and also to the call center environments where they really focused in on refinance transactions. So when we think about 2021, you know, three big scenarios could happen. You know, we could sustain current levels, you know, rates chug along where they are and maybe even go down a little bit. And we continue to see a year like we saw last year. Obviously, rates go down even further and get down to a 1% handle on interest rates. That would be interesting. And volumes could increase as possible. Rates obviously could go up and a significant amount of the rate and term refinances, which represent about 50% of the market, could start to dry up. I've been at this, Britt, I think you said for 10 years. I've been actually, I'm pushing 35 years in the business. Certainly have seen lots of different cycles. And if there's one thing I've learned, if nothing else, it's preparing for those different business cycles and having the ability to really understand, you know, what is driving the business and how I respond to those different market conditions. So the theme here really is around best practices. You know, we work with, most of the top, I'd say 70 of the top 100 lenders in the country in one way or another. And hopefully we have some insights into best practices. So look forward to sharing some of those with you on the next few slides. Really establishing metrics to really benchmark and understand those market changes, not just that rates are down and volumes are up, or rates are up and volumes are down, but how those metrics and market changes could impact your business decisions. And that can happen across a whole different array of areas and portions of your business. So really best practice that we've seen is folks that will put together monthly and weekly business reviews that involve all their different stakeholders and have those key metrics to gauge their business and drive their business to make those data-driven decisions. Putting around the table production, secondary risk and operations, everybody having line of sight into the market. And just some thoughts across those different areas and what metrics might be important to consider. On their operations side, you know, your value to the market, to your borrowers, is really price and process. Process being the operations part, right? Really affirming that value propositions to borrowers. And that was really tough to do this last year. I would say in 2020, if there was one topic more than any other of our clients had with us, was around cycle times and, you know, seeing their cycle times go from 30 to 40 to 60 to 70 to 80, maybe 90, 100 days, and wondering, well, am I still bringing value to borrowers? Am I falling behind? Do I need to make a price move to control those operations? Capacity, all those questions coming in, having metrics to really understand how you are doing in cycle times. And again, as Brett said, refinances is a way to measure it. Purchases, obviously, you're putting priorities into that and closing by the closing date. Refinances, obviously, your variable operational component. Obviously, if you're best in class among your peers in operations, you ought to know that. Obviously, a great way to recruit and retain loan officers. Your loan officers may be wondering if your cycle times are sticking out relative to others. Having that information can really gain some trust across our organization as to where you stand. And then I'll just mention pull through. You know, as Brett mentioned, I had run secondary marketing for a good number of years. Hey, if I hit my hedge ratios just perfect, that's great. I got my pull through just right. But that's not enough, I think. I think what matters equally is that pull through as it compares to other lenders can be a really important driver of your operations and your cost of doing business. If you're pulling through 80% and others are pulling through 70%, that's an operational advantage you ought to know about, and cost advantage. From a market share perspective, and I stole this one from Britt, Britt predicts that the Buccaneers will score 24 points in the Super Bowl. And that sounds great, but is it good or bad? Well, it depends on what the Chiefs score, right? So if your volume is down 20% this month in January versus December, is that good or bad? Well, it might be really good if the benchmark or others are down 30% on average. So having that insight, I think, is critical into the business. Whatever your source of that information is, understanding what is the market doing in real time, and how am I doing relative to that. Transparency into your performance, that really gets production and secondary on the same page. So again, if volumes are down 20% and there's a lot of pressure around price concessions, but then you note that everybody besides yourselves on average is down 30%, is that really the time to be doing price concessions into a situation where you actually gained market share? Business mix is one of my favorites. It's, I think, underappreciated, at least from my perspective, when I think back at my different mortgage careers. We really thought of our products as being a zero-sum game. So we're going to originate whatever we originate. And if I do less government or more conventional or more jumbo, or less government or fewer refis or more purchases, it always felt like it was more of a zero-sum game among my products. And you think about other businesses in the retail store, if they sell 5 products, they're trying to optimize their sale on all 5 products. So when Britt brought up that we saw, where we saw VA IRRRLs were up almost 300% year over year, we saw a 15-year that was up considerably, 20-year was up considerably. Maybe it's not a big product for you, but if your growth in the 20-year or 15-year is, let's just say it was 100% last year, and you saw that the benchmark was at 200%, well, maybe you haven't optimized that business mix, your business opportunity with those products. So really understanding across product types, understanding your share of market across all your products, across different loan attributes. And then, of course, business mix can get into areas around managing your high balance loans in those markets. And then, of course, your risk mix, you know, caring about your neighborhood watch scores for govies. You know, are you weighted? You know, we went through quite a time in March. Are you weighted towards credit scores or higher credit scores? And having that visibility and understanding where you stand as a portfolio lender, as a government lender, across loan attributes and risk characteristics. Price position, I just have price position and one more here to share. So price position, thinking about it, you know, last year, refinances, huge story. A lot of our pricing clients making very significant moves. Large national lenders dialing back their refinance pricing by a point and a half, 2 points. And even if that's not your strategy to dial back refinance pricing 2 points, having that visibility and understanding what others are doing in the market is very significant. You really ought to know when this guy over here does something very significant, which could impact your market opportunity. Talk about price, you know, advertised price versus actual locks. Obviously, a lot of concessions go on in the market in different times. We track those. I think the best practice that I would say, having been a lender, is really having great visibility at a loan officer level into concessions across your markets, across your loan officers, across different products, and really understanding that behavior, if you will. around concessions. Obviously, a lot of people have different models around delegation authorities and such. But at the end of the day, there's a significant amount of business that can be won or lost in that whole concession territory, but just having insight into what's going on there. And I would say that a good number of our clients don't have a lender level, loan officer level insights into trends and behaviors there. One thing that I would say my 3 years here at Informa has really taught me is that loan level pricing attributes really drive pricing differences greatly, and that really leads us to margin management. I would say that in my secondary marketing career, I spent probably 90% of my time on the sell side, on best Xing, making sure I knew where to optimize the sale of loans, knew my best investors, worked with Fannie Freddie, all the rest of it. Did my pay-ups, my, all the good stuff on the secondary side. Very little attention on the buy side. And I would say a best practice in terms of what we've seen with some of our larger lenders is separating the sell side from the buy side, really having somebody responsible for the buy side of the market, and then another person separately responsible for the sell side. That way you're putting an eye towards margin management as a function and getting into those strategies around optimizing your performance across products and loan attributes, whether it's loan amount pricing, note rate pricing, loan to value, credit score, all those different variables. The fact that you could sell it at one price into the secondary market doesn't necessarily correlate perfectly to where you could originate it. And maybe your margins ought not to be the same across loan attributes and note rates and such. So that's really a best practice was seen among our lenders. But then again, there's a lot of margin managers out there, right? So depending on your business model, you may have your loan officers may be margin managers, your regionals may be margin managers, your corporate margin management function. But just having, again, line of sight into that behavior and what the price, understanding the market, whether you're at corporate, a regional person, or at the branch, understanding what your share is doing, understanding what your price position is, can help you make really good margin decisions. Takeaways, getting back to the dogs here, and mine slept through the whole presentation. Hopefully you didn't. We thought we'd share some takeaways, but my COO ate them. You can see the shreds of my takeaways here. And then for Britt, I think it was lunchtime at your house. So looks like Gunnar just helped himself to your lunch. So you're going to go through today, I guess. Yeah. Okay, we have a couple takeaways. So just in summary here, transparency into the market, enabling informed views of lending performance. How am I performing? I'm up 20% this month. Is that good or bad? Well, it feels good, but is it good? Having regular business reviews, just having, even if it's 4 or 5 metrics that you're looking at, wherever the source of the data is. There's different data sources, there's recording data, there's different ways in which you can look at data. But just having those 4 or 5, 10, whatever data points that everybody looks at on a regular basis, look to see where you're sticking out. Let's change period over period, and how ought you respond to that. Being proactive around, okay, if rates are up, if rates are down, if rates stay the same, what am I going to do with my business, and know that answer before those things happen. And leveraging data as a competitive advantage. I mean, that's what's happening in our world, right? Data is going to help you make dough, right? Think about what 1 basis point in your volume would be. What is 1 basis? What's the value of 1 basis point? If you're able to improve your margins by 1 basis point, by 5 basis points, by 10, clearly with margins as they are now, we have the luxury of not having to manage that carefully. You know, whether your margins 400 or 410 or 390 doesn't really feel like it matters much because you're printing as many loans as you can. But we know that that's not always going to be the case in all environments, and that you will have opportunities certainly in the future to think about, well, you know, if I could increase margin by 10 bips, how would I go about doing that? Here's some of our thoughts around creating metrics and transparency into the markets so that you can make good decisions around that. So that's what we had to share, Tony, and the TMC team and family. We will pause here and see what's on people's minds.
Thank you. Thank you so much, Britt and John. That was some great information. We appreciate you sharing that with all of the TMC members that are on. I'm going to remind you now, please feel free to add your questions to the chat or the Q&A, raise your hand. I can unmute you if you've got any questions about the numbers that we discussed. I've got a few questions, so if you'll please be sure and put those in the chat, I'll read those out for you. But one of the questions that I had, you know, given March's economic event, what was the average credit score trend for the balance of the year?
Yeah, thanks. I appreciate that. Yeah, we definitely, it was like watching things go off a cliff, right? So we saw the different, I'll call them cliffs, credit score cliffs, where it, you know, 680, where folks were shutting off that production. Actually, some lenders didn't shut it off as fast as others and found themselves, as I said, sticking out in the market and going, oh my goodness, now suddenly, you know, 10% of my business was between 640 and 680. Now like 40% of it is. The good news, as we progress throughout the year, is that you know, things started loosening up a bit. I would say that, you know, with jumbo loan products in particular, you know, really didn't bounce back a whole lot. But you know, thankfully the market has settled, as everybody's seen. You know, non-QM has gotten you know, reestablished itself in the market in certain ways, and we are seeing our lenders and across those credit score bands that were not represented after March, getting back into them. But we are not seeing people going under, you know, the 620 credit score levels, and really not much below 640.
Okay, great, thank you. And then, you know, the purchase business grew 14% or more. Was that equal for government and conventional, or was there a disparity there?
Yeah, for conventional and for Govy, for purchase business, we had, what really stuck out more than anything, and just thinking back at our, let's go back to the product chart. You know, if there is one, it's, you know, VA IRRRLs were about 5.5% business, but VA IRRRLs really dominates. Some lenders just killed it there. I mean, some were, for a period of time, their VA IRRRLs were up, you know, 500% year over year. So I would say that we saw a ton of growth in government refinances, nearly flat on government purchases. Overall, we did see purchase transactions, as Britt mentioned, up about 16% year over year for the East. I think that was 14% for the national. So for conforming, we obviously saw really good growth in refinances, but for conforming purchases, we saw a better conforming purchase market than we did a government purchase market. And if, you know, I don't know if some of our colleagues on the phone here have opinions, but we did see people in many cases gravitate towards, how can I just get a loan done the easiest possible way? And the easiest possible way last year was VA IRRRLs, government refis, conforming refinances, conforming purchases, then government purchases, and then you get into jumbo non-conforming which, as we saw cycle times as the clear evidence running over 90 days for jumbo loans and refinances. And then, as Britt said, in some markets, well over 100, 120 days. So definitely byproduct because of the ease of doing business. Whatever is easier, you can see in the numbers here, got done.
Yeah, that makes sense. Lowest hanging fruit for sure. And then the last question was, you mentioned best in class. Can you give some examples or some insight how that your clients are making data actionable?
Sure. A number of different examples, but I think the one that really resonates most for me personally was really around, hey, we'd get around the table with my CFO and production and me in secondary and say, hey, listen, I think we want to run a purchase special in this market. And we would say, okay, well, half point, quarter point, whatever that is, and make the pricing change. And then my CFO would roll his eyes and say, yeah, we're just going to give away money, aren't we? And a month later, we look back at our volume and we said, well, I don't know. Maybe we did, maybe we didn't. Our volume was up, 10%, but I can't tell definitively whether that made a difference or not. So I think the best practice that we see here in benchmarking is the lenders saying, hey, listen, I'm going to make a change, whatever that change is, a margin change or something. Maybe I do marketing, whatever it is. Do I get something for it? And having that ability to figure out, did I get something for a decision I made? So here's a really good example. A lender made a margin change last summer. They reduced margins by 50 basis points. And they calculated that for that move, they needed to increase their volume by 10% to be revenue neutral. So knock half a point off, you had to do 10% more loans. Well, that's true, but what if the market's changed? And it turns out after they made the price move, their volume was up 25% month over month. Sounds like they won, right? Well, they looked at the benchmarking. Hey, the market itself was up 10%. So then they could go and look at the CFO and say, yes, we were up 25, the market was up 10, we outperformed the market by 15. My break even was 10%. So guess what? We outperformed, we made extra revenue, we made dough. And then production, secondary, finance, everybody can look around the table and say, okay, we had our metrics in place. We understood however we benchmark it, whatever means you do, is that we were able to make a decision, hold people accountable, and understand our results. Now, TMC is all about benchmarking, right? You guys do.
Right. Thank you for the plug.
Model benchmarking. And some people may wonder, we support it fully. So ours is a little bit different, as you've seen in some of these ways in terms of what we're capturing. But however folks benchmark, we're all for it.
Line is that you benchmark, you have to know where you compare in order to know and be able to level your success. So thank you, Britt and John. Really, really appreciate all of your comments. And thank you. I was going to mention, yes, TMC benchmark for those interested in comparing with their peers. We do have that available. Ask TMC is another platform that we have. If you have questions and want to get information from your peers, it's a lender-only platform. And then TMC Connect. We are leaning heavily into TMC Connect and are going to continue to bring you quality programming. So please come back and come back regularly. Check the member engagement calendar on our website and register for all of these great sessions that we have going on. So Britt Haven, John Sayer, FBX, Informa, thank you so much for sharing your insight on benchmarking and, looking backwards to 2020 and forwards to 2021. As a reminder, this is being recorded, so you guys will receive an email tomorrow with a link to the recording. And wanted to say, again, just really appreciate everyone for being here, and hope you have a great rest of the week.
Thanks so much.
Following this, we've got Tech Talk with Tom. So please hop on that. And then at 4 o'clock Eastern, 3 o'clock Central, we'll be doing, Britt and John will be back doing the West Coast. So if you have not registered for that, please go to the member events calendar and register for that follow-up for the West Coast and see how the West Coast looks with the East. So thank you very much. Appreciate it. Everybody have a great day. Bye.